Why finance so important? Prior to joining Bay Path University as a full-time faculty in the School of Management, teaching business courses, I spent 30 years in an aerospace company. And if I would take my 3 decades of experience and put it into 4 large categories, they would fall under engineering, finance, manufacturing and supply chain, and general management, both domestically and also globally. What I learned earlier in my career, which was in engineering, and then later on as I progressed through the ranks, that the 2 common factors in every organization are managing people and managing finances. All of us, regardless of profit or nonprofit, regardless of industry, every person in the organization, as we know, is indirectly or directly related to organizations' finances and financial performance, and hence overall business performance. So I've always felt, all the way from my time in engineering into even later on in manufacturing, supply chain, and especially in general management, that having some financial acumen is very critical and helpful in being able to manage the organizations and managing the business. So at Bay Path, in our MBA program, where we have 10 core courses, there are 2 bookends, the business foundation on the left and then the capstone on the right. But because I feel, and collectively, in MBA program, we feel that the financial and analytical skills are important. So even in our program, we have sprinkled it along the journey. So this way, even though students do go through more in-depth when they take the management accounting and finance course, but before that, like in foundation, we expose them for a little bit of financial thinking, in marketing, also in research, and later on the strategy and business plan and the capstone. So this way, students do not get overwhelmed just in one finance class. They are able to pick up the knowledge along the way, and that has helped them. So based on same thinking, I have felt that it would be beneficial to create a modular workshops that can be done, in a classroom environment or in a workshop environment. So in this set of videos, I will be sharing with you 4 parts. First one is, why is finance acumen important for non-financial managers? And that could be somebody in engineering, could be in HR, could be purchasing, manufacturing, or general managers. The next one will be in connecting the strategic planning with the financial planning. Every business, in order to survive and grow, they need some strategic planning. But the strategic planning, to be successful, it needs to provide financial results. So obviously connecting the strategic planning with financial planning is important. In part 3, I will talk about some of the key steps, which would be connected to a little bit with part 2, in how do you develop a financial plan for your business. Here I will provide you with some thoughts and ideas and some framework. And the part 4, I will cover financial ratios, which is typically a good way to analyze the financial health of the company. And they can also be used to set future targets. So today, I will be doing part 1. Why is finance acumen important for non-financial manager? And the future series, future videos, I will cover part 2, 3, and 4. So why is finance acumen important? The learning outcomes for this module, I will cover balance sheet and income statement. Now, this is not a finance or accounting class. So here I do not plan to go into the details of how balance sheet is developed how is income statement developed. Here, our goal is collectively that we have a good feel for what is a balance sheet, what is an income statement, what are some of the macro things that go in there, and why are they important to us as managers. Then I'll get into connectivity, and for me, as a prior general manager, and now as a business coach and a business educator, I feel connecting with organization structure and the roles and responsibility when you're looking at the income statement through the lens of an organization is important. So I will cover some of that. And then finally, I will also cover the financial planning process, because once a plan is set for the year, each department gets a budget. I will walk you through what is the typical process that takes place top down, is how the budgets are set for the departments. So starting with, again, that there are two common factors in every organization. Obviously, there are managing people and managing finances. Now, that is true for a large organization, the one we are all familiar with, Apple, or auto companies like Ford, GM, Toyota, Honda, or local corporations like United Technologies, and within that, the divisions, Otis, Carrier, UTC Aerospace Systems, or Travelers Insurance, Mass Mutual. Any company will have a balance sheet and will have an income statement. Those are the key financial statements that managers should be familiar with. There are others, like retained earnings statements and cash flow statements, but for management perspective, if a manager gets a pretty good feel for the balance sheet income statement, they will have a much better understanding of how to effectively move the organization forward and effectively manage it. Now, it's regardless of the size. It could be a bakery, or it could be stores like PetSmart, or it could be franchises like Subway. They will have an income statement and they will have a balance sheet. So what is a balance sheet? Balance sheet has three key components. You got the assets, which is what company owns. This is theirs, they own it. The liability is what company owes. And that could be money that they borrowed from a bank, or any money they received from bondholders. So those are their liability, that they owe the money to the bank and or the bondholders. And the third key piece in a balance sheet is the ownership, which is called equity. Equity obviously is going to be assets minus liability, and so you hope once the company has started and got into a more stable condition or growth condition, there are some points that assets are going to be greater than liabilities, so you have positive equity in the business. So what are assets? Assets are things like machine and equipment. If it is a farm, a tractor is an asset. If it is an office building, that could be an asset. Even the sweaters and shoes in a retail store, they are assets. They're inventory, but they're assets. So from a management perspective, we have to be aware of how much money we have tied up in these assets. Because assets by themselves, yeah, we own them, but they're not providing us with profit or cash flow till we convert them into sales. And hence, managing assets and managing inventory is a key part for a leadership to be aware of. So assets are there for us to generate sales and profit. So if you have a tractor, if you have a machine, if you have a building, if you have inventory, what we want to do is to convert them into sales, and then eventually when we collect the money and become profit and cash flow. So the effective management of asset is super critical for managers. The overall goal when it comes to asset management is to enhance the profitability as a percent of assets, which means that we want to make sure the assets we have are generating as much profit as possible. So typically it's called an ROA, return on assets, which is net profit divided by total assets. So if you want to improve our ROA, the net profit should go up, which is your numerator, and the total assets should go down, which is denominator. Now, just hypothetically reducing the assets doesn't mean that the company is going to be successful. A company can go in and get rid of assets and then get in trouble. The whole idea is to make sure that the assets that are there to provide production of core technology, core product. This way they can selectively decide what should they make, what should they buy, how much inventory should they carry. See, overall, from an asset perspective, you want to make sure that every asset that you have, especially the more expensive ones, are effectively managed. Or from a long-term strategic perspective, when you do invest in a new product, new technology, kind of keep in mind how much assets do you want to invest and why. So the question is, where does the money come from to acquire assets? If you want to buy a machine, you want to buy a building. So balance sheet assets is what company owns. It can come from two places to start out with. You can borrow it from a bank or a bond holder, or you can invest. The shareholders can invest the money. So if you borrow the money, you're basically borrowing it to acquire assets. Or if the owner invests it, obviously you're adding it to the equity, and obviously then you can have your assets. So when the companies start out with, typically that's what they do. There is no sales yet, there is no profit yet. So you basically start out with getting money from investors and or from the lenders, and you start the company. But at some point, the money should come for further investment in the assets from the operating performance, how the company is managed, which means it has to come from the income statement. Now, so this way, a company creates the cash flow by running the business, and then they reinvest it in the business for new equipment, more inventory, if they want to grow the business, or putting it back into employees, etc. Now, when a company does a major investment, for example, a company wants to acquire another company, in that case, they may have to borrow money, or they may have to get investments from the shareholders. But in the long run, it is important that the companies can create their own profitability and cash flow from it. So let's talk about income statement. Again, at a very macro level, as a manager, you should be aware of the macro pieces in an income statement. So income statement is sales minus total cost, which is your profit. So sales coming from our customers, total cost, what it takes to run the business, and that gives you whatever is left over is a profit. So the total cost will include everything. If we are going to purchase something, especially if you have a manufacturing company, you're buying a lot of raw material or components, that will be included. And typically in income statement, it will go into COGS, which stands for cost of goods sold. Operations, manufacturing, cost of goods sold. If a company is more a non-manufacturing type, which means they're not really producing anything, like an insurance company or a bank, in that case, typically instead of calling cost of goods sold, they may call it cost of revenue. Sales and general administrative type costs, which is SG&A, are cost departments like finance, accounting, human resources, legal, overall administration, costs that are not directly related to making a product, and they are considered that. Now, some companies may also have R&D. If the company has enough engineering, especially technology companies or companies that use technology, like some of the UTC divisions, in that case, they may separate out the amount for research and development to how much money they're spending. And then obviously, if there is debt, you pay interest on it, and then you pay tax. So those are the macro pieces in income statement that are included. Now, so if the total costs are higher than sales, obviously we got a net loss. Are there situations where that can happen? The answer is yes, especially when you're starting a new company, or if you're investing in a large project, which may require investment cost up front. For that particular project, if we look at how much net income that particular project is creating, in the first few months, weeks, few months or years, it could be negative. But overall, as long in the long run they flip and become positive, then it is okay. So you want sales to be greater than total cost, and that's going to give you net profit. Now, what happens when you have net profits? Let's say the company has made profit. Where does it go? Well, there are, at a macro level, it can go into two buckets. Either you can put it back in the business, which means you invest into your business, new technology, new equipment, investing in your people, maybe more training, etc. Or you can pay out some dividends to your shareholders. So most companies, if they are doing really, really well, after some time they will give some dividends and they will put the rest back in the business. Now, if a company is paying dividends and all of a sudden it's not doing well, they will stop paying dividends. A good example is what happened with GE. So as I'm recording in September of 2019, as many of you know, GE has been in real financial trouble. The stock value has dropped tremendously. They basically cut back the dividends, and so because they basically were not generating enough internal cash flow and profitability to be able to pay the dividends. So net profit obviously is good. It not only allows you to put back in the business, may also allow you to give something back to your dividend to shareholders. So this will help obviously grow the shareholder value and hence the stock price of the company. Now, so I use the analogy, the net profit is oxygen for the business, which means we can do without it for a short period, or we can use tanks, which means get money from somebody. But in the long run, you got to be able to create your own net profit. So net profit is essential to survive as a business, and obviously compete, in case you have to lower the price or you have to, invest and grow in your business. That yes, at some times you can borrow the company, but in the long run, the company's profitability needs to be positive, over the longer periods. So now I'm going to get into a bit more of the income statement and connect it to the management structure in the organization. So, what have I talked about? The income statement performance plays a key role in sustainability and the growth, but also plays a big role on business valuation, which is the market value of the company. Because if the company grows a profit, its ability to generate cash grows, and hence the value of the company grows. So you'll find companies where their earnings, typically measured as earnings per share for the publicly traded company, are growing year over year, especially if they're growing at a much, much better rate than the peer company in their industry, that their stock price will be performing better, typically measured by price to earning ratios, the PE ratios, and the PE ratios of the companies that are consistently doing better will have a higher PE ratio, and the stock price will be much better than the peer company. So it's important. I strongly believe that the company management team has to effectively manage their value chain to yield above industry average profit margin. Value chain basically is that how we create value for our customers. So if are we designing the right product? Are we manufacturing the right way? Are we producing at the right cost? Do we have the right profitability? Do we have the right technology, etc., etc.? So the overall value chain management and then creating profit margin better than the peer company is what successful leadership team do. So let's look at organization before I can kind of make the connectivity to the some of the macro elements of an income statement. So here is a general management organization. Basically means a general manager who's responsible for overall income statement and balance sheet. So I'm using an example here more as a operations type company, like an aerospace and auto industry. I'm using this as an example. One can use other companies. The department may look a little different. For example, if you're looking at an insurance company, you may have slightly different boxes, but overall, what I am going to talk about, the framework can apply to anything. So let's take this as an example. This particular organization has an operations function, which has got manufacturing, purchasing, and quality, has engineering that does design and development, has a sales and marketing function that obviously deals with the customers and does marketing analysis, has a finance and accounting function that basically is important. Their important job is to make sure all the books are done right, be able to provide the financial data, also provide financial metrics to the organization to help manage it. Human resource, a super critical function, obviously. As I mentioned earlier, the two things that are important is managing finance, but the second one, in some ways more important, is managing people. And then obviously you could have other G&A departments. Now, so let's start out with sales. So sales are products that we sell or services we sell. So I'm using this as a manufacturing company, so I'm just going to, obviously focus a lot on operations. Here, the three departments that are important, especially long term. So let's talk about long term first. So as you're planning the sales for the long term, the sales and marketing people, the marketing analysis, sales people working with the customer play a very, very active role to know where to target the new opportunities. Engineering, working with sales and marketing and manufacturing operations people, obviously look at to see how they can come up with a new product, new technology that can bypass the competition and be able to provide a more valuable product to their customers. The operations, they make the product. So they all three play a very key role. Now in the short term, month to month, quarter to quarter, operations is going to play a much bigger role because they basically, the products are designed, it's already sold, the contract is in place. So the manufacturing people, the quality and the purchasing people worry about on-time delivery, quality, making a target cost. So collectively, even though in a short term, operations does play a key role, engineering does help and support, and sometimes even salespeople because they may have to, interact with the customer. So overall, sales piece of the income statement is, I would say covered by these three organizations. Now let's look at some of the cost pieces of it. So let's start out with cost of goods sold. Cost of goods sold is what does it take to make the product, right? And it's done in operations, manufacturing will make it. If they're buying the product, purchasing will play a role, and obviously quality plays a role to make sure the products that we are buying and making are satisfying all the quality requirements. But the reason I drew the box around engineering also is because engineering plays a key role. Because engineering that has designed the product that operations makes, and during the design phase, they do work with operations to make sure that the product is producible with the capacity and the capability the operations has. Or if the new capability is required, engineering works with the operation to create the capability. So the engineering plays a role in terms of how difficult will the part be to make it, or how easy it will be to make it. So they play a key role as far as what will be the cost of goods sold of the product. That's why you're going to find a lot of very, very good companies that are in operations. They have worked really closely with engineering to be able to do that. Now, then you have your SG&A functions where you have departments like sales and marketing, finance and accounting, human resources. Other G&A could include like legal, could be a group that does strategic planning to look, for opportunities. Some of these could be outsourced by some companies if they are large, small companies. But overall, you're going to find these types of activities that even though if they're outsourced, you still have to pay for it, and they will go into the category of SG&A. And then you got the engineering that, responsible for the R&D. So you can see here that from an income statement perspective, you got sales, you got the cost of goods sold, you got SG&A, and you got R&D. And if those are the key pieces of an income statement. Now, so what I want to do next is to talk about how the departmental goals and budgets are set. So as I go through the process, you will have a pretty good feel for, department where you are, how would the top-down budgets were set, and as you see sometimes during the year, why there is need for a change, etc., etc. So all organizations go through this process called financial planning and budgeting. Typically, it's done in the fourth quarter of the year, for the next year. Financial metrics play an important role as far as how they are doing it for setting budgets for the departments, to look at it both short-term and long-term. And also the overall company's long-term strategy also plays in a role. For example, if they're planning to get into new technology, they may have, they're gonna, earmark some more money for engineering, or if they want to get into new markets, They may spend more money in marketing and sales. So that will really depend. All that is put into consideration when they set the budget. So how does the process typically work? The process typically works if it is a publicly traded company. They will set a target for EPS, or earnings per share, for the following year. And typically a lot of companies will set the target for multiple years, but the detailed planning is done for the next 12 months or the coming year. Now, if it is not a publicly traded company, then they will start at the net income. But from the earnings per share, you basically come up with a dollar value that the company needs to create a profit for net income. So the net income becomes a profit dollar value that the company needs to create. From there, they can estimate for the next year. This is the planning process. So they're setting the budget. They set the target for net income. They know they need X dollars, million, billions, whatever. They can estimate the taxes based on the tax rate, based on they know what's happening to the tax codes. I mean, pretty close to they can estimate for the net income they want to generate, how much taxes they will pay. So that leads into earnings before taxes, EBT, earnings before taxes. Now from there, they will then say, okay, we have to allow for interest because they have debt. They know what it's costing them. Or even if they're planning to get more debt or pay down debt, they get a pretty good feel for what the interest expense will be for the next year, coming year, or the calendar year for the next 12 months. From there, you end up with what's called earnings before interest and taxes. So what does that mean? If you can generate enough earnings before interest and taxes, from there we pay interest expense, which gives us earnings before taxes. From there we pay taxes, and from there we get net income. So as long as we can achieve the EBIT target, there is a high likelihood we'll achieve the net income, because typically interest expense and taxes don't change that much within a 12-month period once the targets are set. So EBIT becomes a key parameter for the operating management team to focus on. Now, what goes into EBIT? So EBIT, first item in EBIT is your sales. You got sales, money that we get from our customers. You have your cost of goods sold, which is basically producing the product or producing the service. You have SG&A function that I touched on it. You have the R&D function, which is the engineering functions. All these go into EBIT. So if we can manage these four categories successfully, we can manage EBIT and hence manage the earnings per share. Now, what goes into sales? Obviously, you got the price and the quantity. So as long as we charge what we plan we're going to charge for price, and as long as we sell as many as we plan we're going to sell, the sales will be fine. Then you got the manufacturing, procurement, and quality related costs that are part of cost of goods sold. That will include labor, your material, purchase material, you got quality, and all the overheads associated with it. Then you got the SG&A functions, administration, you got the human resources, you got the sales and marketing, you have finance and accounting, and you got engineering that goes into R&D, and sometimes there may be some other G&A functions that may not have a full department by itself. Like there could be an activity that they hire, external people for consulting or for legal help and so on. So all that falls into one of the categories. So if the sales, cost of goods sold, SG&A, R&D to happen as the plan, the box on the left have to also come through. But what happens more often than not, that some of them could change. And hence, from a management perspective, it is super important that the managers have some kind of a buffer or a hedge. Because there is some likelihood that something may not go as planned, because we're planning it for what's going to happen for the next 12 months, and something could change. For example, we can start the month of January and February, everything is fine. We get into March and things start to slow down. And the quantity goes down. We're not selling as much as we thought. Or we have to lower the price, or some combination of both. That means the sales are down. If our sales are down, if everything else stays the same, our EBIT is going to be down, and hence we will not achieve a net income target. So if you have a hedge or a buffer, someplace which is typically managed by the finance manager or the director or CFO and the general manager, they can use it if necessary. But if you don't have enough hedge or buffer, or the buffer is all used up, then one does not have a choice but to either accept that the EBIT will not happen, which typically is not acceptable, and hence they're going to focus on trying to reduce the cost. And that's why you're going to find sometimes in the middle of the year or sometime during the year, a lot of pressure on cutting on travel, not going on conferences, cutting back on expenses, anything they can do to be able to manage cost, or even sometimes if the economy is not as good, then they may consider furlough and so on. And so you can see why the budgets have to be adjusted during the year depending upon what happens to all the major components of EBIT, the sales, cost of goods sold, SG&A, and R&D. So cash flow is also a key part. So where does the cash flow come from? The most valuable piece of the cash flow on a sustaining basis comes from the net income that we talked about, which is on the left. And you add back depreciation, which is a non-cash expense. But overall, from a manager perspective, if you are managing your profits really, really well, year over year over year, you have a good flow of cash flow. Now, if you are an operating manufacturing type company, you will also want to pay attention on your working capital. It is called working capital in the sense of dollars associated with it, working in the sense that we are using it on an ongoing basis, and that includes three things. Inventory, which is the money we got tied up in an inventory. Could be, if it's a retail store, could be items on our shelves. And if they're not moving fast enough, or if we got the wrong items, obviously we got a problem with our inventory not moving. Or in the factory, if machine is down, or if you're not getting the product in on time, you've got inventory there. The whole idea of inventory is an asset. Our goal is to convert that into sales as soon as possible. So we want to try to minimize inventory as best we can. Accounts receivable is also another category of asset, which is the working capital. This is the money that our customers owe us. What we want to do is to manage it and try to get as soon as possible. And the accounts payable is contracts we have with our suppliers. And I put that in green is because this is our suppliers financing us in some ways. So better terms we have with the suppliers, better accounts payable. So working capital is a combination of inventory plus accounts receivable subtracting accounts payable. Now, we also, if the company is paying dividend, that's a use of cash flow, obviously, if they want to do that. And any capital expenditures they make, if they want to buy a new machine, want to go build a new building, etc., that would be capital expenditure. So from a management perspective, on an ongoing basis, there is a focus on working capital. Those are the three pieces that you want to pay attention to. Now what I want to do is to transition into and setting the stage for the next module that will be covered in the near future, and that is the connectivity with the strategy. So let's get back to the organization structure. So here I'm showing you the green line with the sales, two lines with the boxes of cost and so on. So organizations, aside from obviously managing day to day and month by month, they're also going to think about longer term strategies. For example, if you're in operations, you're going to think of a way to make your process leaner, more effective processes. You're going to decide what you're going to make versus what you're going to buy. You're going to work with engineering for integrated product planning, especially if you got a new product coming around the corner. Your procurement strategy, your purchasing strategy, what should the commodity strategy be? Are you going to have a long-term supply relationship? Are you going to have some kind of strategic alliance with somebody? Are you going to do a joint venture? All that stuff obviously plays a role in terms of the operations. Engineering will be there to look to see, hey, working with the customers, what are the new products they should be investing in? Intellectual property that will help them create entry barriers, so they create some kind of a barrier so the competition cannot come in, at least for a while. They get a head start on it, before the competition gets in. Also look at synergy. If they got products, is it better to figure out a way to sell them as a system? So there are a lot of things engineering will do and decide where they want to invest the money and what return they will get. Sales and marketing people play a very key role in understanding what the competition is doing through the lens of working with the customers. Then you got the finance and accounting. They play a role of make sure that they can get the best cost of financing for the near term and the long term, especially if they want to get into acquiring a company, they need to borrow money, or if they got a debt, how to get a better interest rates. Also, they play a key role in providing the financial reports to the management team, how effectively the metrics are, how, keeping it simple on a dashboard, not spending a ton of time creating the reports, but to have enough basic information to run the business. Then you got other G&A functions. That could be somebody is looking opportunities for merging, for acquisition, or even considering divesting some of their old product lines. And then you have HR, which plays a super important role. Why super important? Because there are two things, as I mentioned earlier, that are important for management. A, managing finances, but the other one, I think more important, is obviously managing people. So focusing on how to enhance employee engagement. There is enough research done over the last few years, especially recently by Gallup, that says that if you can enhance employee engagement, not only helps your retention, not only helps your employee being more committed to the organization, but overall it does help the overall financial performance of the company. And from there, leading into the talent optimization strategies or mentoring programs, these are the areas that recently have done a lot of research, and there is tremendous opportunity to be able to strategize in those areas. So key takeaways from this module that I am going to now wrap up. That financial performance, i.e. income statement, is a result of how effectively the overall value chain is managed. When I say value chain, we're talking about what value we provide to our customers, all the way from products we design, the products we manufacture, the products we sell, the products we service, etc., etc. The components of income statement are aligned with departments responsible and accountable in the sense that obviously you can see that the management team is managing income statement and balance sheet, and the department within the organization manage pieces of it. Now, if you have a strategy, for example, alliances, acquisition, make, buy, etc., that you develop we are doing it basically to enhance financial performance and hence should address costs and benefits in various parts of income statement. Is why do we say we want to do it? Why go through the trouble? Why go make the investments, etc.? So the end goal of a strategy is to enhance cash flow, and typically in the long run it has to come from the income statement. So the next module will be on connecting strategic planning with financial planning. I kind of touched on some of the ideas. I will take a couple of examples and provide some framework to how one would look at it, at least at a macro level. So I hope this was helpful. In kind of recognizing the importance of why, even for non-financial managers, finance knowledge is so important, and how they can take this knowledge and make themselves better leaders and managers.